So we're here continuing our interview series with Craig A. Hawkins, certified financial planner and tax guy, based out of the Los Angeles area. And Craig, I wanted to ask you. I know you have an independent financial planning business that you operate now, working with individuals and families, but you also have a background where you've worked with some bigger institutions and kind of with people that are very wealthy and even like have millions and millions of dollars. And is what you learned at seeing what those people are doing with their money, how does that impact what you do today when working with individuals and families?
Well, the concepts are exactly the same. You know, tend to keep it fairly simple, and also work with clients in managing expectations. A lot of times, I think when you go down market, individuals assume that you're going to be able to get 9 to 11% returns out of the market if you pick the right investments. Um, that's sort of the wrong way to think of things. The markets, first of all, don't move in a linear fashion. There are going to be ups and downs in the market that you have to come to um, realize that that's just a fact. Um, Also, knowing that if we can provide some diversification with the assets, it's a lot easier to provide diversification if you have a portfolio that's $4 or $5 million. But if you have a portfolio and someone's just starting out and they have $10,000, how do you get that diversification? Um, will your trading cost eat up all of your earnings? So we have to manage based on the size of the portfolio. And you can do that, but those are some of the things that we look at. But managing expectations is probably the one thing that I do, and not only managing it, but either proving it to you or showing you what the true returns look like in the market. I think when you have a client who has a $4 to $5 million portfolio, they're not necessarily looking to knock the cover off the ball. They're looking to hit singles. I find, when you're just starting your wealth accumulation, you're trying to hit the home runs. And when you're trying to hit home runs, you're going to strike out quite a few times. You might get one or two here and there, but you're going to strike out far more times than you're going to hit home runs. Um, and those, when you strike out, those are losses. And like I said earlier, a lot of times people don't understand that when you have losses, you have to make back that loss in order to break even. So I believe if you lose 25% in the market, you need to make back at least 36% to break even. Similarly, if you lose half of your money, so you start with $100, you lose 50%, now you have 50 cents. Or if it's $100, you have $50. In order to get back to that 100, you have to make 100% from
Right.
that $50 to get back to 100. So it might not happen, especially if the markets are averaging, in the 8% range. How long does it take you to make back 100% if you're making 8% going forward? So it's
Yeah.
going to take a couple of years. If we can manage those expectations and lower your risk and provide you with some proper allocation, we can minimize those losses by having the expectation that, hey, we might not outperform the market this year, but at the same time, when there is a disruption in the market, we're not taking huge losses. And that's the key, is managing our losses.
Yeah, and that makes sense to people that have reached a certain level of assets, kind of have learned that lesson maybe along the way.
Yeah.
And maybe some of us who haven't gotten to that point. are able to, get some information and some advice of how to look at that while you're on the road.
You need to take into consideration taxes when you're making investments. Are the investments you're investing in is it going to be ordinary income that's coming out of that investment, or is it dividend income, or is it capital gains that we're taking? Um, Long term versus short term. Those are things that we look at when we're making those decisions.
Because that will really affect the actual net that the person ends up with.
Correct. So, being a day trader, buying and selling, um, you know, might not be the best thing for the average individual. You're making 20%, but then you've got your trading cost associated with buying and selling, and then all of that's going to be considered ordinary income. Are you creating more of a tax liability for yourself, or um, are you hurting yourself doing that?